Hi, everyone. Thank you for joining the NBDA today. We are happy to have you here with us, and we are happy to have Mike Barnidge from QBP with us to talk to you about financials. Um, Mike did this presentation at a Frostbite event, and it was very good. So we are really happy to have him here. And take it away, Mike.
Great, thank you very much, and thank you for the NBDA to invite me to this. Definitely, am in love with the bike industry and love participating in different learning opportunities like this. So thank you very much for inviting me. Just a little bit about me before we get going. I've been with QBP for about 11 years. Kind of been in and out of the credit department throughout those 11 years, but I've also had some experience within our sales team, both as an account executive, but also as in the leadership position. So kind of my areas of experience there on the right-hand side, I call them areas of experience because I'm always learning, I'm always experiencing them, and I don't think they're ever going to get to expertise, but that's my goal. But financial analysis, financial statements, that's kind of where my head is throughout most of my workday, along with managing our credit department. On the sales leadership side of things, I was involved in margin planning, designing the sales bike program that we operate off of right now. And then in my past life, been involved in banking and commercial lending with a wide variety of small businesses. My main passion is working with small businesses and working in financial statements, and kind of understanding that financial conversation. So today's discussion is very much right up my alley, but it may not be right up your alley. So if you have questions, please put them either in the chat or in the question section, and we'll try to get to some of them at the end of the day here. Just kind of jumping right in, I want to go through our agenda. Really, the purpose of this conversation today is to start with some basic information about financial statements, kind of what they are, why we do it, what the importance of them are. And then we're going to build on that to kind of get to the main piece of the conversation, which is to look at a concept called the cash conversion cycle. And then at the end of the conversation, we'll kind of jump into some additional resources and education opportunities for you that I've been paying attention to and I think are valuable. So we're going to review the basics to start, just to kind of make sure that we build everybody up and we're all on the same page here. So we're going to look at the income statement, the balance sheet, statement of cash flows, which some of you look at often, some of you never look at, and some of us are all intimidated by it. So we'll take a little bit deeper dive into that statement of cash flows. And then we're also going to look at common ratios as we talk about each one of these documents to make sure that you know where your eye should be landing on some of these different pages. So first and foremost, why do financial statements matter? From my view, at least from the credit analysis side of things and the financial statement analysis side of things, I view the financial statements as a great opportunity for you as a small business owner to create a profit plan. So they are a great opportunity to review your results, but it's a better opportunity to take those results and look at what the next step of your business is, where you want to go, how you want to achieve either greater profit, higher revenue, expand into additional locations. It all starts with the financial statements and understand what your capabilities are. From there, I think that you get into the empowerment conversation. If you feel confident about your understanding of your financial foundation, it really allows you to take the next step to guide your team, whether that's your management team within your business, maybe it's just your partner within your business or your employees. But your competence and your knowledge of where you're going trickles down into being able to empower that next level to go out and help you achieve what you're trying to within your business. So that also builds confidence in you as a business owner. There's a third thing here, which is providing the understanding and knowledge to get the most out of your partners. And I think sometimes this is oftentimes overlooked. As small business owners, Oftentimes we're kind of just stuck in just looking at what's going on in our business, and we'll reach out to some of those additional partners as we need it, whether that's your accountant or your banker, potentially the additional shareholders, your insurance broker, whoever that might be. A good solid foundation of you understanding what your financial situation is within your business allows you to go out and potentially negotiate with those partners to get the best possible deal, but also to make sure you're getting the most value out of those partners that participate in your business in some way. So I think the financial statements are incredibly powerful, and it's a great opportunity to continue to increase your knowledge in what you're looking at, why it matters, and then maybe the next piece, which is what do you do after this? So let's start with just reviewing the income statement. And what I try to do when I present financial statements is I try to get the book knowledge out of the way and really just focus on what's the layperson's view and language that we might use to understand some of these documents. So the income statement, oftentimes called the P&L or the profit and loss statement, really just shows how much profit a company makes or doesn't make over a given period. That period could be a month, it could be a quarter, it could be a year, 2 years, but it is really just a testament to what were the sales, what were the cost of our product, what were the expenses, and did we make money at the end of the day or not? From my view, it's a key indicator of whether the business model is financially viable or working. Given all the costs and expenses, it answers that question: are we making money? And potentially, do we need to tweak our business model a little bit to make a little bit more money and have a little bit more financial security within our business? The image that you see at the top of the screen, I'm going to use this structure and kind of this style throughout the presentation. If you look at the handouts on the toolbar there, you've got access to some of my examples as well as blank documents that you can potentially input your own numbers into if you see fit at the end of the presentation or within the next couple of weeks. But going back to the income statement, we're going to look at the first couple of sections here. So first of all is revenue. Sometimes it's called revenue, sometimes it's called sales, but in this example of total sales with $2.3 million, that's really your total revenues less any returns to get that total sales numbers. So it's the total income generated by the sale of goods and services. So not just product, but also the services that you sell. And kind of ratio wise, the best thing to do is to track this year over year, and looking at months compared to last year, the same month, to kind of get an understanding of how well you're doing or what has changed so that you can make additional changes in the business to accommodate for them. The other piece is the cost of goods sold. So that $1.45 million in the 2018 period, that is the cost of your product. That's primarily what is represented there. So what you pay for your product. Oftentimes that's going to include the cost of the individual product as well as the freight to get that product to you. In some cases, I've seen that merchant services or your credit card fees that go into that sale is part of the cost of goods sold. My advice to you is be consistent in the way that you represent what goes into both your revenue as well as your cost of goods sold, so that the conversations that you have internally within the business as it relates to gross margin is consistent year over year. If you're consistently taking things out of cost of goods sold or putting them back in, you're likely to confuse yourself, your management team, potentially your accountant. So the advice there is be consistent in how you're presenting the financial statements and the income statement internally. I view gross margin as your first opportunity to consider the idea of profit. I say that it sets the table for profit. You still have your overhead and your expenses after this, which we're going to discuss. But if your gross margin is extremely low, the opportunity for a high net profit is going to be severely challenged. So gross margin, want to make that as large as possible, knowing that we've got expenses coming after this that we're going to have to accommodate for. So the next section can kind of be a little bit overwhelming. And so this is all the other expenses that go into your business. Operating expenses, we often refer to the operating expenses of the business being total payroll and your occupancy expense. So when we look at total payroll, we're saying salaries, wages, potentially bonuses, benefits, those all go into the cost of your payroll because they're attributed to the employees that work for you. And then occupancy is we're looking at, your lease or your rent expense, any repairs directly related to that facility, and then any utilities that go into that lease or that rent expense as well. So operating expense is kind of the two largest items within your expense structure, total payroll and total occupancy. The next section is selling, general, and administrative expenses. Oftentimes what you'll see is everything will be communicated under selling, general, and administrative expenses, including your operating expense. But technically, selling, general, and administrative expenses is really your overhead. So that's going to be advertising, insurance, your telephone bill, any office expenses, travel and entertainment type expenses. So it's really kind of segmented away from your occupancy and your payroll. And then we get down to total operating income and any other non-recurring expenses or income after that, along with interest expense. And then eventually we get down to net income. All of these are viewed as a percentage of your total sales number. So that total payroll at 16.96% for 2018, that is 16.96% of your overall sales number. So all of these numbers, at least on the income statement, are all as a percentage of sales from a ratio perspective. Moving on to the balance sheet. This is probably a document that you're looking at maybe a couple of times a year, probably not as often as the income statement, but it's just as important. The balance sheet from my perspective is really just tallies a company's assets, liabilities, and owner's equity at a specific moment. It offers a view of financial strength or weaknesses at a moment of time, at a specific moment of time. Layperson's view of it, what do you own? So what are your assets? Who do you owe? What are your liabilities? And then who are the shareholders and how much value do they hold within your business? Really jumping right into the next page here, we've got the first section, which is assets. And assets is going to be divided up into two different categories. We're going to have your current assets, which is going to be anything that is cash or items that are easily convertible into cash projected within the next 12 months. And then after that, we've got long-term assets or fixed assets as they're often called. And this is really your property less any depreciation. So this could be your shop truck or your shop van. It could be the building that you're in. Those are kind of the two primary long-term assets that you're going to experience within one of these types of small businesses. Your inventory, at least in the bike business, is likely going to be the largest asset within your business year over year. It always seems to be between 65 and 85% of total assets for most bike retail businesses. In some cases, when you're a little bit smaller, it accounts for 90 to 95% of your total assets. But as you kind of grow and diversify a little bit and have a little bit more cash, not as much inventory, other current assets in there as well, the percentage starts to come down a little bit. What we've been seeing recently is that average cash is typically going to be between 5 and 15% of your total assets for a retail business. So depending on the size of your business, that's potentially 2 to 3 months worth of expenses. Inventory, again, almost always the largest asset of a retail business. And then, like I said, long-term assets or investments, buildings, equipment, items that if you're in a pinch, you can't easily convert those assets into liquidity or into cash very quickly. The other side of the conversation is liabilities. So again, we've got two different categories here within liabilities. We have current liabilities and we have long-term liabilities. Oftentimes, your current liabilities are going to directly support your current assets. So accounts payable as a current liability, it's got a maturity of less than a year, so due to that vendor within the next 6 months to a year. That's going to directly relate to the inventory that you do or do not have on hand. Sometimes there's still the bill, even though you have the inventory paid off because the bill is not yet due, the invoice is not yet due. So short-term or current liabilities are really just short-term debt instruments, credit cards, lines of credit, they are due within the next year. Of course, the AP, the accounts payable vendors, and then also the other sneaky one here, which is the current portion of the long-term debt. So the part of your long-term loan that is due within the next 12 months would also be listed in your current asset or your current liabilities, excuse me. And then long-term liabilities are going to be, any future maturities that are greater than 12 months. So you might have auto loans in here, you might have SBA loans. Obviously, you could have mortgages for your building in here as well. Those typically directly apply to the fixed assets within your business. So there's some good comparison points between current liabilities and current assets, and then long-term liabilities and fixed assets. At least from my perspective, some of the things that most financial analysis involves is, first of all, we're going to look at liquidity within your business. And we're going to compare your current assets to your current liabilities. This is known as the current ratio. And we want this ratio to be 1.4 to 2, somewhere in that range. And I'll give you the example of your inventory. If you have $100,000 worth of inventory that you're reporting on your balance sheet, and you have accounts payable that's tied to that inventory of $100,000, that's a current ratio of 1. And I always take the next step and say, okay, what if things get really tight within my business and I've got to move some of that inventory, I've got to move some of that $100,000 in inventory and create cash very quickly. I might be using some discounts on the sales floor to kind of get that to move. And so if my ratio is just 1-to-1, I've got 100,000 in inventory and 100,000 in payables, I might not be able to meet my payables by just selling off my inventory at cost or at the price that I want to. So I need a little bit more of a cushion. So that 1.4 to 2 is really what gives you that cushion to know that if you've got to liquidate your assets, you still have some breathing room in order to cover your payables with a little bit extra. So that liquidity ratio is extremely important to kind of keep track of throughout the year and just get a clear understanding of where it's at. You're likely to feel it before you see it. So you might feel like you're a little bit cash poor, or you might feel like you're just a little bit under having the ability to make payments when you need them. So you're likely to feel it before the numbers start to validate that. The other thing that financial analysis typically looks at is the debt to equity. And this is comparing your total liabilities to the equity that you have in the business. And really, it's just a measure of the amount of debt that you utilize to run your business. Typical range is going to be, from 2 to 5. And this number typically isn't dramatically moving month to month. It's going to be a little bit more of a gradual change throughout the year. I would focus more on liquidity first and then debt to equity second, as far as short-term solving problems versus long-term, am I healthy enough as a business to continue to run sustainably? And then activity ratios. We're actually just going to leave the activity ratios here for a moment because we're really going to take a deep dive into those later in the session as we start to talk about the cash conversion cycle. So now we're going to jump into the statement of cash flows. And oftentimes when I ask somebody to send over their statement of cash flows, or we start to discuss it, I see their nose wrinkle up a little bit, and it's not a fun conversation because it can be a complex document, and it's not something that you look at all that often. And so the point of this conversation is really to just engage you on what the statement of cash flows is, what it's meant to do, and then how we can maybe take a different look at it to give us some better, more understandable information. The statement of cash flows is really, it's the amount of cash that enters and exits a business over a given period of time through these various activities of operating activities, investing activities, financing activities. And we're going to take a deep dive into each one of those activities so you're aware of what they actually mean. In kind of a layperson's view of it, I think it's the map of what happened based on changes experienced in both documents. So it's kind of pulling different pieces of information from the income statement as well as the balance sheet to recreate what happened over the course of that year or over the course of that 6 months. So you can kind of track where your cash went and kind of how you got to this position. So let's first talk about cash balance versus cash flow. So I'm presenting the kind of top half of the balance sheet with just looking at assets. And so we can see that in 2018, at the end of 2018, we had $81,000 in cash. At the end of 2019, we had $50,000. So consider that at the start of 2019, we had $81,000 in cash because that's what we ended 2018 with. So we started with 81,000 and we ended at 50,000. That 81 and that 50, those are cash balances. The cash flow is that $31,000 difference. So there you go. That's your 1 minute cash flow statement. It doesn't really explain much other than the fact that there was a change. We know something happened. We spent $31,000 more in cash, or $31,000 exited the business over the course of the year, but it doesn't really give us a lot of information about what actually took place. So that's why we start to go through each one of these different activities, as they're called on the statement of cash flows, and kind of identify how did cash move through the business by categorizing them in different buckets. So we're going to start with operating activities. In one of my previous slides, I had a note about sources of cash and uses of cash. So sources of cash is cash that is coming into the business. A use of cash is cash that is exiting the business. So these first two bullet points kind of really clarify that. Cash received from customers. So, that's our sales revenue that's coming into the business, or collecting cash for the procurement of goods or services for that customer. And then cash paid to suppliers and employees is cash that is going out the door to suppliers or to pay our employees with their weekly paychecks or their biweekly paychecks. Interest paid, that is typically interest that is being paid to, could be a supplier, but typically it's going to be your bank or potentially a shareholder that's provided you a loan. So that is cash going out the door. That's a use of cash. And then interest received, potentially on a money market account. If interest on a money market account still exists, that's interest that is coming back into the business. And then of course, income taxes, net of refunds, or potentially an income tax refund is cash that could be a source of cash or a use of cash. So view these operating activities as kind of the core of the business. You're selling goods, you're paying for expenses. These are just a couple of different examples of sources of cash and uses of cash that you could see within these operating activities. Next up is investing activities. So this is primarily going to be, proceeds from selling of property equipment. So if you sell your shop van, you're going to have cash come in the door. That would be an investing activity. And so investing activities are typically going to involve an asset of some kind. Capital expenditures, maybe you're going to buy a new software platform, or you're going to upgrade all your credit card devices and you have to pay for that. That could be a capital expenditure. And of course, vehicles, other equipment that go into the business, that's going to be cash going out the door as a capital expenditure. And then if you have securities, stocks, bonds that you hold within the business, the sale of those marketable securities would be a source of cash because we sell it and we have cash coming back in. Typically speaking, the investing activities are pretty light for small business retail, but there's going to be times where you're going to have this conversation where investing activities will definitely come up as an opportunity that you need to plan for the cash to come in or to leave, but also do some tax planning to be aware of what's going on. Financing activities is kind of the last section of that statement of cash flows. So we've got a couple of different things in here. This is really any financing that is utilized to run the business. So net borrowings or payments under a line of credit. So if we borrow from our line of credit, that's going to be a source of cash because cash is coming into the business. If we're going to make a payment on that line of credit, of course, that is cash going out the door to pay for that line of credit. Issuance of long-term debt. So if we go out and get an SBA loan for $100,000, that $100,000 is a source of cash because that is cash coming into the business. And then the corresponding payments to reduce that long-term debt loan is going to be a use of cash. So we've got to use the cash that we have to make those payments. And so what we're doing with all these different activities is we're tracking changes both within the income statement as well as in the balance sheet, primarily year over year, but it could be quarter over quarter, to identify the variance and being able to create a map of where the money is going and potentially why it's going there. So now we're going to kind of break it down and kind of chunk it up with some numbers. So first section, we're going to look at cash flows from operating activities. So we know that we received $51,000 in cash from our customers. We paid for inventory. We paid the wages for our employees. We had to pay some interest to the bank. And then we had to pay for our income taxes. So the net cash after all those different transactions took place is $24,000. Then we add the next section on. And so we go to investing activities. So we purchased property and equipment, which $100,000 going out the door. So we used $101,000 to purchase that property and equipment. And then as we get down to financing activities, we're going to receive proceeds from long-term debt to purchase that property and equipment from investing activities. We've also got some payments that we made on our line of credit of $10,000, which is cash going out the door. And so for that financing activity section, we've got $89,000 used or brought in, depending on how you look at it, for that cash section. And now we roll it all together. And so our net increase or potentially our decrease in cash was $12,800 for that time period. So this is how I typically feel at this point in the presentation myself. We've covered a lot of ground. We've talked about the main documents that exist. We've talked about a couple of different ways to view them, some ratios, took a deep dive into the statement of cash flows, which oftentimes a lot of people aren't looking at because it can be cumbersome and it can be confusing to understand where it's going. But I think there's a better way, at least in my opinion, and that's to do the same thing that the statement of cash flows is doing by pulling different parts between the income statement as well as the balance sheet, but utilizing it in a different way to give us a better understanding of how we're performing and put some time aspect into the whole conversation, which is a little bit more understandable for the majority of people. So that is the cash conversion cycle. And so the cash conversion cycle, it measures the time it takes a business to convert inventory purchases into cash flows. It's going to pull components, like I said, from the income statement and the balance sheet to kind of recreate this information. And it starts to introduce the element of time. And so it's kind of grabbing these, excuse me, grabbing these different pieces and really just putting them on a level playing field so that we can analyze them as components that are similar instead of, confusing components that may not exist on the same spectrum. So cash conversion cycle, very simply put, it measures the time it takes a business to purchase their inventory, to sell their inventory, collect payment on it, and then pay suppliers. And as I mentioned before, we are going to come back to this idea of these activity ratios. These are the activity ratios, which is analyzing our days in inventory outstanding, our days in sales outstanding, and then our days in payable outstanding. So very simply, the transaction that we're looking at for the cash conversion cycle is that it equals our days in inventory outstanding plus our days sales outstanding less our days payable outstanding. And one important thing that I really want everybody to understand, inventory, because it is such a large asset within your business, you can't be asleep at the wheel in navigating your inventory and understanding what's going on, how quickly things are moving, how quickly things are not moving, potentially how slow they are, in being able to execute on the sale of that product and get new, fresh product in the door. And so I like to think of this as the moment your inventory, the moment that you receive it, it is on the clock and it's participating in the execution of your profit plan in some way. So the moment that you receive it, you've got to have a clock that looks like it's hovering over every item in your store, and you're thinking about, what was my plan for that inventory? How quickly do I anticipate that it's going to be sold? And then how does that play in with all the other factors of my business, which is maybe how quickly I'm getting cash from my customers, and when do I have to pay my vendors, and do all those different factors line up? Do I have a problem? And so the better that you can get at doing this up front before you bring the inventory in the door, really establishing what your plan is, the better your result is going to be at the end, because you're going to know at what point you need to make a decision to move that product out, to create the cash to be able to pay your vendors, or maybe it's so valuable that you can let it go past that that time where you have to pay your vendors, and you're going to use other sources of cash in order to pay that bill early, even though the inventory hasn't sold. So think about, what's the purpose of that inventory that you're bringing in, and know that it is on the clock the moment it gets into your store. So what we're going to do is actually go through this worksheet that I've created, and it corresponds to another one of the documents that I have in there, which is a sample income statement and balance sheet. So what we need is the balance sheet, the income statement, that cash conversion cycle worksheet, and then potentially your calculator, your phone, your computer, whatever you're utilizing to help run this calculation. And so really what we're going to do is, for each one of these activity ratios, we're going to look at our financial statements. We're going to find the numbers that are being represented, add them to the sheet, and then run the calculation and kind of talk about what that actually means. So let's start with the days inventory outstanding. So this is inventory divided by cost of goods sold. And then the result of that, we're going to multiply it by 365 days in this case. You can also use other numbers, whether it's 90 days, or you could use 180 days to look at it on a twice a year type of model. But really what this number provides us is that it represents the number of days that inventory sat around during the time period. And so you want to get this number as low as possible, because it means that the less time inventory is actually sitting on the shelves, sitting in storage. Like I said, it's getting that inventory in your store is an execution of your plan, and you want that plan to go as quickly as possible so that you can get your cash and you can realize your profit as quick as possible. So lower is better. One thing to note about this is that this is not a roll-up number. This is a financial statement calculation. It is not looking at every item that came into your store, assigning a number of days that it took to sell that inventory, and then adding up all the products in the same manner to get to the top number. It is simply using the data that exists at a very high level on your income statement and balance sheet to help you identify trends, help you identify problems, and at least give you a baseline for where you are right now and potentially where you want to go. So for this transaction, for this calculation, excuse me, we're going to grab our inventory number of that $1.2 million, and we're going to grab our cost of goods sold number at $1.45 million. Throw that into the calculation, and we're going to come out with 302 days. So if you think about that from a turns perspective, that's one solid turn for the year, and maybe a quarter, so 1.25 turns for the year based on 302 into 365. So in this case, the numbers are telling us that inventory seems to be moving a little bit lethargic and a little bit slow. You'll see how this number plays into the overall calculation at the end, but it's pretty revealing what it's telling you as far as the next steps that you need to consider. So if your number is high and you compare it to last year and it's dramatically high, start with your largest dollar position and create a plan. Because this is looking at dollars on your financial statements and not units, you're going to start with your largest position in dollars. So that might be, all of your high-end road bikes. That could be all of your power meters. Whatever the largest dollar position is, you should have a plan for how quickly that product is going to move out of your business. If you're bringing it in for a purpose to sell it, is it executing in the way that you anticipated? Is it selling as quickly as you anticipated? If your first response is, we didn't have a plan for how it was going to sell, we just needed to get that product in the door and then we were going to create our plan, that's your first opportunity to do a little bit more work on the front end to identify, okay, so we're going to bring in this number of bikes or this number of wheel sets, whatever it might be. Here's how we expect to sell it, when we expect to sell it. Here's why it fits into our portfolio or our product mix. And then also, I think what's even more important is what is plan B? So if we're expecting to bring in these 30 bikes and we hope to sell them within 90 days, and we hope to have a blended margin on those bikes of, say, 37 points, what if that doesn't happen? What are we okay with? So what is that plan B as far as how to get that product out the door? If it's not, what we might say is obsolete product and has last year's group on it, or it doesn't have the right wheel set or tires or whatever it might be, maybe it can last a little bit longer within our inventory. And it's okay that it's not 90 days, that it could be 180 days that it takes us to get through that product. The point being is the only right answer is what fits in with your business and what your plan is. So have a plan and then have a plan B that is still acceptable if plan A doesn't go as expected. And then I also put here at the bottom, understand why you are placing a large preseason. And so this isn't a bike company saying that you shouldn't place large preseasons, or it's not saying that you should place them. My advice here is to understand why you're doing it. And a lot of that product that you bring in and those really big bulk chunks, it's hard to move through the system. And when you bring in a lot of product, it's hard to understand what you have left at certain times, how it's performing, how it's moving, especially if you're maybe a 3 to 5 person business, there's a lot of work to do. So managing how well things are selling is important, but from a financial review perspective, it might not be the most important thing that you're looking at on a daily basis. So understand why you're doing the preseason and establish some goals to start out with to make sure that you're getting the results that you expect. Next up is days and receivables. We'll probably go through this pretty quick just because receivables for a small retail business is likely not to be a big number or much of a concern. It's more of a concern for me as a vendor that we self-finance the terms that we provide to our customers. So if we give you 30 days to pay or we give you 90 days to pay, at least for us, that's not backed by a bank loan or some insurance. That is managed by us and self-financed by us. So we care how quickly payments get made back to us. And so we need to have a good mix of net 30 invoices and net 180 invoices. For a small business like yourselves, you're not actually giving customers financing directly. So you're not collecting on customer purchases over the course of 6 months or a year or 2 years. You enlist a sales finance company that will help that customer finance the purchase, and then they take on the collection and the payment of that. So if your accounts receivable or your days in receivables is greater than 5 as a retail business, I would ask the question of what's in my receivables. Sometimes it's a receivable due from an employee. Sometimes it's a receivable from some short-term financing or a shareholder. There's various reasons why receivables are going to be in there, but typically speaking, you're not going to have receivables that are directly to a consumer. The lower, the better. You want to make sure that you're under 5. If you're over 5, I would question what's going on there. So for this calculation, we're going to grab our accounts receivable dollar amount, that $45,000, and we're going to grab our total sales dollar amount at that 2.3. As we run this calculation, again, using 365 days, we're coming out with 7 days. So it takes us 7 days to get the cash from our consumer based on this activity ratio calculation from our financial statements. So in our example, that's a little bit higher than the 5. So what I would implore you to do is dig in, find out what's actually going on there and what those receivables are that are represented within your balance sheet. Next up is just as important as inventory, in my opinion, and that's the days payables outstanding. So accounts payable is what we're talking about here. And this is the number of days it takes for a company to pay its suppliers. For you, the higher the number, the better. You want as much time to pay off your bills as possible. And you really want to make sure that there's this relationship between your largest inventory position and your days payable is as close together as possible, because then you don't need additional funding to make the payments for your vendors before you've paid off your inventory. So there's a really big important relationship here with your largest inventory position, in my opinion. So we're going to grab our accounts payable number from our balance sheet in the liability section of $884,000, and we're going to grab the cost of goods sold at $1.45 million. As we do this calculation, we get 223 days. So as a business, it takes us 223 days to pay our suppliers. So kind of coming back to the fold, and I'm going to bring all these numbers together, which will be a little bit more revealing. Again, the cash conversion cycle. It measures the time it takes a business to purchase inventory, sell the inventory, get payment in form of cash, and then send that cash back out the door to pay suppliers. If we roll all these numbers together and do the calculation, for this example, we get 86 days. So our cash cycle is 86 days. Our inventory is, on the books for 302 days. It's taken us 7 days to to actually get cash from our customers, and then we have to pay our suppliers in 223 days. So 86 days really in a nutshell represents the shortfall that we might have in cash. And it's primarily a difference between how long our inventory is sitting around and when we have to pay our vendors. So it's the first identification that if something doesn't change, we're going to need to go get an outside funding source to bridge that gap of 86 days so that we can pay our suppliers, keep them happy, don't have any undue expense on that side of things. Or we're going to need to accelerate how quickly we're moving through our inventory. And so we're going to get that 302-day number down something closer to the 223, so we don't have such a big gap to navigate in order to make sure we have enough cash to run our business. So you can kind of see that the inventory number really drives a lot of the performance of our business. And as you start to compare it as apples to apples with some of the other components that exist within your income statement and balance sheet, it can be pretty revealing to what you need to do next, or potentially what you don't need to do next. The average that we're seeing for the bike industry is about 120 days. That's a lot of funding that you have to go out and organize. So you might be selling some inventory quicker than others and using that cash to pay bills on another item of inventory that hasn't sold yet. So you're kind of always playing this ping pong of back and forth of making sure that you're getting the right amount of cash to the right sources throughout that process, but also getting some cash yourself, because that's why you're in business in the first place, is to make money, have a living, provide for your community, and provide for your shareholders within the business as well. Some other kind of high level thoughts about this. A high or positive cash conversion cycle is often a sign of poor liquidity and is the starting point to really assess your financing needs. We kind of covered that idea. If it's really high, you've got to figure out how to bridge that gap with some form of financing. A low cash conversion cycle shows an efficient business that is converting inventory into cash quickly. That high and low are kind of vague statements, but it's all relative to your business. Right now would be a really great time to figure out what the bottom of your cash conversion cycle might be. So, a lot of you are crazy busy. You're selling bikes that maybe have been collecting dust for a couple of years, and finally they're moving out because everybody wants a bike, and that's kind of all you have left, even though you're trying to quickly supply from all your suppliers. We're definitely experiencing a boom. This is a great opportunity to figure out how low that cash conversion cycle can go. And so that's one benchmark. The other one would be to look back a couple of years where maybe you weren't as successful, things weren't moving as quickly as you anticipated, you were carrying over inventory a couple of years or 1 year in a row. That might be the highest it's been. So once you establish kind of those guardrails of the lowest and the highest, now you can start identifying where do you feel like you need to be in order to run the business as efficiently as possible without making yourself go crazy. So right now I would say once we finish up June, take the last quarter and identify what that cash conversion cycle looks like. And that's going to be your low that you can compare everything against off in the future as far as how good it can get. And then establish some kind of different threat levels within that number structure. So if your cash conversion cycle is 15 during this time period, and your highest cash conversion cycle was 130, the answer of where you really should be kind of is within those two numbers. Maybe it's 85 is where it's most comfortable. But you've got to establish how wide is my gap, and then what is most comfortable as far as how I can most efficiently run my business. This is just a couple of examples of different public companies and their financial statements and doing the same cash conversion cycle. I would say Coach right there in the middle is probably the one that is somewhat comparable to the bike industry. Their product oftentimes sits a little bit longer before it sells. It is often high dollar, items as well that could be comparable to some of the parts and accessories or bikes that we're selling. And so their cash conversion cycle is 133 days. And so again, I look at this as they've got a funding gap of 133 days because they have to pay their suppliers within 61 days. How are they doing that? How are they meeting that funding gap, and what kind of opportunities are they taking? Whereas Amazon, they've got 16 days worth of cash on hand that they can do something with before they have to pay their suppliers, is the way to view that. So what do I do now? First of all, calculate your own cash conversion cycle for multiple periods and compare it. I've put a document within the handouts that, as long as you put all your financial information on the green highlighted areas on the left-hand side of the document, everything on the right-hand side will calculate on its own. So made it very simple. You actually don't have to do the math on your own. And then identify opportunities. So again, compare those large buys that often carry large invoices. Do those days match up with a payable? Are you converting your receivables quickly? Again, not a huge concern point for you, but something to be aware of. And then do your invoices match up with when you expect to have cash to pay them? So look at your biggest buys first and make sure that those terms make sense. And then look at all invoices after the fact and make sure that it seems to make sense based on what your goals are. So next steps, we've shared the information in the financials template. Calculates each one of these items with very minimal data input. This PowerPoint is also going to be available. And then I implore you to not stop learning. Just a couple of really good books and one document out here. So The Cadence is a Tale of Fast Business Growth. I think this is a really good, easy read, but it gives you a good understanding of how to approach different problems within your business to get the results that you want. Traction is going to be more for that company that you might have 2 or 3 locations, and now you've got a leadership team. And how do you plan your business and really get the results that you want across a little bit wider of an organization? And then if you want more information on the cash conversion cycle, this is a hyperlink that you can click on within the PDF document, but it leads you to the JP Morgan Working Capital Index. And essentially they took the cash conversion cycle of the S&P 1500 and identified them, in different groupings, including different industries, big businesses versus small businesses. So it's really a little bit more detail in the cash conversion cycle. It's a little bit nerdy, but it's an interesting read if you have the time to do it. And then also the final point that I would make is, I've gotten the opportunity to participate in the P2 group to both present as well as be involved in the conversation and see how it works. And it's a great group to get some peer consulting. You also get the professional facilitation. You share your numbers on a monthly basis, primarily with KPIs. You get to meet as a group, probably remotely this year, but still get to meet. And it really gives you the opportunity to just kind of dig in on your business with somebody that's not involved in your business. They're not even a competitor within your same area, that you can bounce ideas off, see what they're doing, see what are some better opportunities to run your business. I think it's a great value. It's definitely affordable from the big picture as far as the results that it's going to return for you in your business. And if you have questions and you want to follow up with me directly, I'm always open for kind of an unbiased conversation that's not directly related to the QVP credit position you might be in. I've got lots of tools that I've collected over the course of the years that reach out and we can probably solve the question you might have. With that, I'm going to turn it over for questions.
Perfect. So if you have questions, you can put them in the question box or the chat box. And while we wait for a few questions to come through, just a reminder, grab those handouts before we end this webinar, because those are really, really helpful, and they'll still be available, but we want you to just grab them while they're right here. right, we've got a question here. How do I get involved with a work group? I'm assuming they're asking about the P2 groups. For that, yes, okay, so if you send an email to info@nbda.com, we can send you all the information you need for that. We also have information on our website. Under programs on our website, you can go to P2, and that'll have some testimonials, it'll have some information on the KPIs, but for information to get involved, go ahead and email us and we will send you all that info. Thank you. All right, question for Mike. How often do you recommend doing a cash conversion review?
I would start out by doing it quarterly, and I would compare it this quarter of this year to last quarter of last year. I think this is actually the quarter to really do it, because we've got, at least for the majority of businesses in the bike industry, this June, May, and April timeframe is really telling for the overall performance of the business throughout most of the year. Again, depending on your locale and what your weather environment looks like, but a good 3-month review of it can really yield some good results. Definitely do it at the end of the year, and I think doing it with your leadership team or your partner or whoever is involved in the business that is a partner, whether it's inside or outside, educating them on here's what this is, here's what it means, and here's how often we're going to review it. It's just like margin, but I think it gives better understanding if you look at it on a 3-month window than if you consistently look at it on a monthly window. Even at QBP, we run these metrics every single month, but it's just a software package that pumps them out, so it's easy to review them. But sometimes we get lost in it because we're looking at it all the time, and subtle changes don't always catch our eye. So sometimes that quarterly meeting can be pretty powerful in your business to really understand, okay, what do I need to do next quarter in order to create a better result for me?
All right. Looks like one more. Are there store management software packages that helps compile this information for my day-to-day business activity?
So QuickBooks likely has some of these ratios built into it. The KPI part of the P2 group is based on Retail Toolkit, which is another program that is really a great opportunity to do a little bit more business planning, and it's business planning from many different aspects, whether it's service, employee engagement as far as when they're working and kind of planning out the production for the year. But I believe Retail Toolkit has some AP days and AR days that's in the data as well that you could potentially utilize it as a pay for service, but it's a very compelling product. Otherwise, you can use the template that I provide and quite simply just input the numbers that are relevant, and that can produce the result for you as well. But I would look into QuickBooks, Peachtree, see what kind of ratios that they have before taking the next step.
All right, we're right at the hour mark, so I think we should wrap up for now. If people have any more questions, please email us, or you can email Mike directly. And thanks for being here. And if you're not a member of the NBDA, if you are interested in P2, you can find all of that information at nbda.com, or you can just call us or email us, and we'll be happy to talk to you. And thank you so much, Mike, for being with us. This is a really great information for everyone to have, so thank you for sharing.
You bet. Thanks for inviting me.
All right, have a good one.
Take care.